There is a quiet crisis of confidence unfolding inside the corporate office parks of Mountain View, Cupertino, and Palo Alto right now. And it has absolutely nothing to do with enterprise software evaluations or artificial intelligence computing power. Instead, it has everything to do with personal balance sheets, capital preservation, and the sudden realization that the local residential real estate landscape is shifting directly beneath our feet. For the past several years, the prevailing narrative across the Bay Area has been one of absolute scarcity, unyielding demand, and a relentless upward trajectory for asset values. But the data we just printed for the month of June has completely shattered that illusion. We're looking at a real estate market that is fundamentally running out of speculative momentum, driven by a macroeconomic backdrop that looks pristine on the national evening news, but feels incredibly fragile to the professionals who actually power the Silicon Valley economy. If you look at the national headlines right now, the American economy appears to be an absolute juggernaut. The headline unemployment rate just ticked down yet again, landing at a historically tight 4.2% for the month of June. In any standard economic cycle, an unemployment rate that low indicates a consumer base at peak strength, flush with disposable income, and perfectly positioned to bid up premium real estate assets. But when you look beneath the hood at the actual non-farm payroll expansions, June completely disappointed Wall Street with incredibly slow, sluggish job growth. This is the ultimate macroeconomic paradox. Unemployment is low, not because hiring is aggressive, but because the labor pool itself is structurally contracting. Corporations are not expanding their headcounts, they are quietly tightening budgets, consolidating engineering teams, leaving open roles unfilled, and shifting capital away from human labor toward technology infrastructure. When that underlying employment anxiety collides with hyperlocal real estate market of Santa Clara and San Mateo counties, the impact is instantaneous and profound. Job security concerns are beginning to fundamentally alter buyer behavior, transforming what used to be aggressive fear of missing out into defensive analytical caution. This psychological shift is severely amplifying our traditional seasonal trends, turning a normal summer lull into an arena of severe divergence. Today, I'm going to break down the hard combined June real estate data to show you exactly why local home prices are contracting even as total inventory shrinks, and I will expose the highly deceptive pricing games sellers are playing behind the scenes to manufacture artificial bidding wars. If you are planning to buy or sell real estate in the Bay Area in the next 90 days, you cannot afford to misinterpret these signals. I'm going to arm you with the raw, unfiltered truth so you can avoid making a catastrophic, multi-million-dollar mistake with your hard-earned money. To truly understand why capital is moving the way it is across the peninsula and the South Bay right now, you must first master the rigid, bi-seasonal calendar that uniquely governs Silicon Valley real estate. Unlike almost any other major metropolitan area in the United States, the Bay Area housing market does not operate on smooth, continuous spring and summer liquidity cycle. Instead, our market is divided into two high-velocity transaction windows punctuated by two distinct seasonal pauses. The first and most dominant selling season kicks off as early as February and runs at a frantic, breathless pace until June. It hits an absolute brick wall the moment the high school graduations conclude and summer vacation travel begins. The second season, our fall market, starts the day after Labor Day and runs at highly compressed, intense clip until Thanksgiving, before the market goes into total hibernation for the winter holidays. The summer months of June, July, and August represent a historically slow transitional lull. Active buyers pause their search for international travel, school breaks disrupt relocation schedules, and general market participation thins out dramatically. In a normal year, this summer slowdown causes a predictable minor dip in transaction velocity. But this June, seasonal pause is being greatly amplified by the slowing job market numbers. When tech professionals see lukewarm employment data, paired with persistent whispers of local corporate restructurings, their willingness to take on massive debt commitment shifts from offensive to pure defense. Even if their stock portfolios look healthy, the psychological threat of volatile labor market alters their entire approach to house hunting. They are no longer willing to blindly bid up properties just to secure a piece of land. The absolute euphoria of the early spring has evaporated, replaced by an environment where buyers are scrutinizing every single disclosure line item and demanding absolute clarity before spending any money. Let us look at the sale data for Santa Clara and San Mateo counties to translate exactly how this psychological shift is affecting the actual numbers. The median home sale price across all property types, including single-family home, luxury estates, suburban townhomes, and condos, landed at $1,680,000 for June. That represents a 1.2% decrease month over month from May. More importantly, it also represents a contraction of 2.6% compared to this exact same time last year. Let that number sink in. While the broader stock market indexes hover near historical highs, the median property values in the most valuable technology hub in the world has actually depreciated over the last 12 months. This is undeniable empirical proof that the peak pricing of the spring window has officially rolled over and is heading downward into summer doldrums. Sales volume is reflecting this exact same hesitation. We saw 1,649 homes successfully close escrow across both counties in June. That is a microscopic 0.3% decline month over month, though it sits 3.2% higher than the frozen volume we saw last year. But the real story of June, the metric that completely exposes the structural fractures in our local market, is the massive surge in formal price reductions. Out of those 1,649 successful sales, 251 homes, or staggering 15% of the entire market, had to execute a public price cut before they could induce a buyer to sign a contract. When you segment that data by property type, the split becomes truly alarming and exposes the deep division in buyer profiles. For single-family homes, only 122 properties, roughly 10% of the segment, required a price drop. The sheer scarcity of single-family land on the peninsula and in prime South Bay pockets continues to act as a structural floor for standalone homes, protecting homeowners' equity. But if you look at the condo and townhome sector, 129 units sold after a price reduction. That is a whopping 32% of all condo and townhome sales in June. Think about that math. Nearly 1 in every 3 multifamily listings had to wave a white flag, slice their pricing, and capitulate to the market just to get a buyer to close. Entry-level inventory is officially sitting, heavily penalized by escalating homeowners association dues, 6.5% borrowing costs, and the sudden defensive retreat of the first-time buyer pool. Meanwhile, our overall active inventory numbers are shrinking, ending June with 3,169 homes available for purchase. This is a 5% drop month over month and a 6% decrease compared to last year. Ordinarily, falling inventory implies a tightening market that should drive prices up. But in this specific economic environment, because buyer demand is dropping faster than inventory is shrinking, prices are actually softening. You can see this directly in the velocity metrics. For the homes that successfully closed, the median time on the market remained low at 13 days, compared to 12 days in May and 13 days last year. This tells us that the flawless turnkey single-family homes are still being absorbed in less than 2 weeks. But do not let that low median fool you. The homes that do not fit that narrow description are accumulating massive amount of days on market behind the scenes, forcing that 15% of sellers to slice their prices to get ahead of this dramatic market shift. This brings us directly to the microclimate reality of the ground game and the psychological warfare currently taking place at local open houses. Right now, there is an incredibly deceptive pricing illusion occurring in Silicon Valley that every buyer and seller must understand. Many homes are coming on the market at what I call the seller's dream price, an inflated aspirational number based on the peak frenzy of March or April. When that property sits through the first few weekends with zero offers, the seller is forced to execute a sharp price adjustment downward to align with reality. Once that price is reduced to an attractive, realistic level, it suddenly catches the attention of motivated buyers who have been waiting on the sidelines. Those buyers step in, compete against each other, and bid the home back up above the new, lower asking price. At the end of the transaction, the public records show that the home sold above asking price. But there is the catch. It is sold above the current reduced asking price, not the original listing price. If you are only looking at the surface level data of sale to list price ratios, you are being completely lied to. You are looking at engineered bidding war designed to hide the fact that the seller had to capitulate first just to get you through the front door. This deceptive environment has completely intensified the battle between the turnkey premium and the fixer-upper penalty. In a summer market overshadowed by slow national job growth and stubborn living costs, buyers have absolutely zero appetite for risk or extra capital expenditures. If a home is perfectly staged, thoroughly inspected, and completely move-in ready, buyers will still compete for it because it represents absolute certainty. They can lock in their mortgage payment and completely avoid the variable, hyperinflationary cost of contractors, permits, and building materials. But if a home is a fixer-upper, or if it has major deferred maintenance issues, the penalty is swift and brutal. Buyers are discounting those properties by hundreds of thousands of dollars, completely walking away from anything that requires their physical time or liquid cash reserves. They are refusing to subsidize a seller's past laziness when the cost of capital is sitting at 6.5%. The sellers, operating under severe time constraints due to an upcoming relocation, begin to panic. They looked at the current median days on market, which stands stubbornly at 13 days, and realize their property is crossing into stale inventory status. That is the exact moment where psychological leverage transfers entirely from the listing side to the buying side. To salvage the deal, the seller drops the price. This sharp adjustment acts as a digital tripwire. Active buyers who had completely ignored the property at its original inflated price point suddenly receive an automated alert. The home is now perceived as a bargain. Over the ensuing weekend, multiple buyers submit offers, creating a secondary localized bidding war. The property ultimately sells above the new reduced asking price. When the sale closes, the automated real estate apps proudly report that the home sold for more than its listing price, maintaining the public illusion of a seller's market. If you're a seller looking at this data, you need to accept that the peak spring liquidity window is officially closed. The summer months are slow, low volume period, and if you attempt to overprice your property right now, you will be severely punished. My advice to you is this: you cannot price your property based on what your neighbor's home sold back in April. You are entering a season where buyers are highly cautious and foot traffic is thinning out. If you want to sell fast and extract the absolute top of the market this summer, you must use an intentional strategic underpricing strategy to engineer your own urgency. You must list your property slightly below current value to shock buyers into action, forcing them to compete against each other. You want buyers fighting each other, not negotiating against you. If you try to test the market with an aspirational dream price, you will instantly become part of the 15% of sellers who are forced to make embarrassing public price cuts. Once your listing crosses that 13-day median threshold, it becomes stale. Buyers will smell blood in the water, and you will ultimately walk away with significantly less equity than if you had priced it correctly from day one. If you're a buyer, this summer market is your ultimate arena of opportunity. While the casual buyers have paused their searches to go on vacation, and the anxious buyers are paralyzed by the latest slow job growth reports, your competition has fundamentally evaporated. This is the exact window where you can exploit sellers' fatigue. Your tactical playbook this month is to completely ignore the surface-level listing price and perform a forensic investigation into the complete property sale and price history. Do not trust the primary days on market counter on your phone. Look for listings that have been canceled, withdrawn, and quietly relisted under new numbers to reset the clock. Track the exact date when property was first put on the market. When you identify a motivated seller who has been sitting through the summer heat for 30 or 40 days, or a seller who has been already forced to make a price adjustment, that is exactly where you strike. You do not step into a bidding war on a fresh listing. Instead, you target the stale inventory, exploit the lack of summer competition, and demand heavy price concessions, along with substantial seller credits to buy down your interest rate, preserving your liquid capital while solving the seller's summer inventory nightmare. Successfully building and protecting wealth in a market this deeply fractured requires an incredibly precise, data-driven approach. You cannot rely on generic national news headlines about unemployment and absolutely cannot trust cookie-cutter real estate cliches. Because Silicon Valley is operating under a highly specific dual-season calendar, your real estate strategy must be completely customized to your personal balance sheet, your exact equity position, and your long-term lifestyle desires. Whether you are a seller trying to correctly structure a listing to spark a summer bidding war, or a buyer trying to hunt down a frustrated seller hiding behind a recycled listing, there is no generic solution. We need to sit down and have a raw, unfiltered conversation about your specific numbers, your preferences, and your financial boundaries. Reach out to me directly. Let us connect, cut through the headline confusion, and construct a strategy designed specifically to protect and grow your capital in this summer market. This is Michael Talis with Coldwell Banker Realty. Stay disciplined, protect your equity, look past public illusions, and let us position your wealth exactly where it needs to be before the post-Labor Day market opens up. I will see you in the next update.